I want to welcome everybody here on a nice, cool evening on October 26th. This evening, we're interviewing Leonard Goodman, who wrote a book on life settlements called Here Lies Your Money, and is also founder and chairman of the Life Insurance Settlement Association of Canada. So Leonard, I'd like to ask you a couple questions to get going here. I understand that you've been in the life insurance sector for a long time. Can you give the listeners a brief synopsis of your background?
Sure. First, the name of the book is Why Are Canadian Seniors Worth More Dead Than Alive? Just to correct that. I came into the industry in 1963, licensed with Manulife. I had a very good career. In 1978, I was the president of the Life Underwriters Association advocacy for agents. Subsequent to that, I became aware of what was then called the single company representation, which limited agents to producing or presenting products from the company with whom they were licensed, to the exclusion of other companies, of which there were numerous in those days. I found that to be offensive, objective, and not in the best interest of my client. And so I advocated for and subsequently was able to create what is now called multiple company representation, wherein a broker or agent qualifies, has the ability to represent any one of the life insurance companies who sell life insurance. That was met with resistance, but we worked out the deal. Later on in the late 80s, early 90s, I became aware of the secondary markets in the other jurisdictions outside of Canada, namely referred to as the life settlement industry, wherein an insured, having no further need for the life insurance policy that he or she had purchased, needed to either cancel or otherwise dispose. The cancellation offered no, if anything, financial value. The secondary market, known as life settlements, provided a fair market value based on mortality, age, life expectancy, and was incredibly greater than the amount of funds that they might have received from a life insurance company. I started in Ontario to advocate for that. I created the Life Insurance Settlement Association of Canada, which pretty much mirrored the Life Insurance Settlement Association in the United States, and which was a major advocacy of the same vein. And here I am.
I understand you wrote a book that, amongst other things, points out the opposition of insurers to an active secondary market. And in fact, goes on to maybe even threaten financial advisors who happen to mention this option to clients. Is that true? Maybe you could elaborate on that.
Yeah, from personal experience, when I became involved in the advocacy for life settlements, at the time, one of the companies that I was licensed with, a major company, advised me that if I continued to pursue that, they would terminate my license to do business with them. After significant correspondence and communication, wherein I said, no, I'm not going to do that. I'm going to continue. They, in fact, terminated my license and my ability to do business with that company.
So it's interesting, Leonard. I did read your book, and I thought to myself, life insurance agents today who act, I always thought, in the best interest of their clients, they must be in a real conflict of interest if they are treated like you were, and they are either threatened to lose their license or actually lose it as you did. Can you just sort of comment on that? Do you think that there's a significant conflict of interest there?
I was in a fortunate position of saying, I don't care if you terminate my license. At this point in my life, I was pretty secure, pretty comfortable with myself. But indeed, if you take the agent or the advisor who might be in his 40s or 50s and is very dependent upon the ability to develop business and produce business, that individual was in fact threatened with the probability of his inability to produce income.
So they would have terminated his contract, I take it. Well, that's very interesting. Well, you can see the conflict then between doing what's right for your client and still being able to earn a living, but clearly under threat from the life insurers. That's a pretty sad commentary on major financial institutions today in a time where everything is looking for conflict of interest to be reduced in the way we do business. Anyhow, Len, I've studied the life insurance settlement and loans model, not nearly as much as you have. And I've had people, when I explained this, first of all, they weren't largely aware of it, but I've had people say, well, I wonder if that is going to increase insurance premiums. Can you comment on that?
Well, yeah, I've been asked that question. First of all, understand that the actuarial calculations of life insurance premiums are like Fort Knox. They're kept secret. But the reality is that the basic cost of insurance, and life insurance industry is based on statistics. How old are you? What's your health? How long do we think you're going to live? And how much do we have to charge you? If you take the basic cost of insurance and eliminate all the extras, the cash values, if it's permanent or universal life insurance, the reality is it should not have any impact. In fact, if you take into account the last 20 years, particularly, where longevity has improved. If you look at the standard industry's records of commissioners' standard mortality tables, you'll find that today a 60-year-old has a greater life expectancy than he did 10 years ago. Therefore, the cost of insurance, pure insurance, should really have come down, hasn't.
Okay, so is the flip side of that it's highly unlikely that if policies are kept in play, that it will influence the increase in insurance premiums over time?
That's smoke and mirrors. It really, the industry has, from my experience, put out a great deal of misinformation, and it just doesn't hold water. And I have challenged the senior executives, many of whom I've known well, to a debate to discuss this. They won't. But the bottom line is that, in my opinion, and nobody has proved me wrong so far, or even tried to, the cost of insurance should not increase just because a life settlement transaction takes place. Because at the outset, they should have countered for the possibility that there would be a claim.
My last question, Len, is I understand that there is a private members bill that has been introduced to the Ontario legislature. And what I did in preparation for this is I went back and read a prior bill that was put forward, and it was vehemently opposed by the life insurance industry, CLHIA.
Right.
And it's my understanding, and by the way, I have contacted them to see if they were interested in being interviewed on this topic, and they have declined once again. But I guess my question to you is, with this new bill coming in that will provide an active and regulated life settlement and loan business, otherwise the secondary market, the only claim that I can see made by the life insurance industry is that it could hurt seniors. Now, I can tell you that I qualify as a senior, and I think you may qualify as a senior. Does that hold any water, Len?
No. First of all, you need to understand, Paul, that CLHIA is a life company supported organization. It speaks for the insurers, not for the public and not the brokers. Now, if you want to go to organization that speaks for the agents or brokers, the Canadian Association for Advanced Life Underwriting, CALU, has very much been on board with this concept. Sadly, and they actually asked me to a meeting about 2 years ago, their executive, we had a chat, and they did in fact put a proposal on the table at one of their annual meetings, which was very quickly, it disappeared because the industry said to CALU basically what it's saying to the individual. You can't talk about this. You can't promote this. You can't tell your clients about this. Forget about it.
Well, I'm a chartered accountant, and a few years ago, I was down at a chartered accountants conference in the US, and it was very actively talked about there as saying to accountants that if they actually had clients with policies, to make sure that they checked out the alternative of a life settlement or loan as opposed to just letting it lapse, because apparently the vast majority of policies never pay out their death benefit, and it's worthwhile checking to see if there's value there. Do you think the same thing holds in the Canadian market, where there should be that alternative made available?
Oh, absolutely. I can tell you that 4 out of 5 policies sold in Canada, they're never paid as a claim because they terminate. And I can further tell you that with respect to the value of the policy, it's an asset, and it should be considered an asset in no other factor than a house, a car, a boat, a plane. At the time you don't really require it anymore, you should be permitted to look at the market and say, what is this worth in the marketplace? And we can't do that here. You can do that in the United States. You can do that in UK, Japan, Australia, Germany. Some of the provinces of Ontario are not as stringent. The industry is trying to change that.
So Len, I want to, just in the interest of time, I want to thank you for your time and for being very clear on what this issue is. I'm sure we'll hear more about it as it goes in front of the Ontario legislature. And let's just hope that the politicians who are looking at this at least understand things from the consumer side and the asset issue that you pointed out. As an accountant, I know an asset from a liability, and it seems to me like if somebody is paid into something and it's in their name, it should be their asset to act on as they see fit. So thanks again for your time. Really do appreciate it, and I'm sure we'll talk again.